right, so good evening. So here we go again. So what we're going to be looking at, so in today's revision session, we'll be covering progress test 1 to 4 and course exam 1. So like you all should have looked at course exam progress test 1 to 4. So we're going to be going through each of the questions, discussing, and then looking at the solutions. So for progress test 1, we have 10 questions. The first 3 questions is based on this scenario. So let's now get into it. So the first 3 questions, so let's read the scenario. It says data for questions 1 to 3. A company has the following statement of profit or loss and statement of financial position extract. So the PBIT 500,000, interest 50, PBT 450, the tax 50% into 25, preference dividend and ordinary dividend giving you dividend retain giving you retain of 100,000. So your retained profit being 100,000. Your net current assets $5 million, non-current assets, sorry, $5 million, current assets 2.5, less current liabilities give you net assets of $6 million. So the first 3 questions are based on this scenario. So I need your input, and let's look at each of them. The first question says, what is required is the ROCE, the return on capital employed. All right. How do we go about calculating the return on capital employed? Right. So the formula for return on capital employed that will be used is that we know it's your profit before interest and tax over your net assets, your PBIT over your net assets. That's what we're going to use to get the answer for number 1. So what did we get for question 1? The profit before interest and tax over the net assets. What was the answer for number 1? And let's go through these. If you didn't do it, you have to be doing it very quickly now, because we expected you to have done these before our session. So it would be 500,000 over 6 million, and that gives you 8.3%. Okay, so that would be C, the answer for question 1. So question 1 answer would be C. Question 2 now. Question 2 asks for dividend cover. How do you calculate dividend cover? It is the profit after preference dividend over your ordinary dividend. The profit after preference dividend, just preference dividend alone, over your ordinary dividend. That's why you get dividend cover. So your profit before any dividend was 225,000. But you have to take out the preference dividend alone and then now put it over what was the dividend. So the profit before any dividend was 225 minus preference dividend of 25,000. Mean the profit after preference dividend is 200,000, right? So 200,000 is a profit after preference dividend. The preference ordinary dividend is 100. So 200 over 100 would give you 2 times. So the answer to question 2 is so all right, Rashida, you're not hearing anything. Anybody else is hearing anything? Because that's a little strange. Check
Sir,
your
I'm hearing you. I'm hearing you, but you're very low. And can you just remind me which one of the papers you're doing?
All right, we are doing progress test 1 to 4. We are doing progress test 1 to 4.
Thanks.
All right, so yes, so we are looking at progress test 1 to 4. So question 1, as we said, the answer was C. And for question 2, the answer was B as in boy. Because return on capital employed is the profit before interest and tax over the net assets. And for the dividend cover, it is the profit after preference dividend. Again, the profit after preference dividend alone, right, over the ordinary dividend. So it would be 225 minus 25, which gives you 200 over 100, giving you 2 times. So the dividend cover would be 2. The third question that is based on the same scenario is question 3, looking at interest cover, right? So the third question, let me just ask if are you hearing now, Rashida? Everybody's hearing now? I know he said one person, let me just type within the chat just in case.
Yes, I'm hearing now, sir.
Wonderful, wonderful. Okay, perfect. All right, so question 3, interest cover. For that, it would be a profit before interest and tax over interest. So based on the question, the profit before interest and tax was 500,000 and the interest was 50,000. So 500 over 50, 10 times. So the answer would be C to question 3. So for question 3, the answer would be C. So moving on. Question 4 now have its own extract. So question 4 and 5, I think, are for question 4, 5, and 6 might be based on the same extract. So question 4 is that extracts of financial details of a company are as follows. Make it come on. All right, so we have our sales, our cost of sales, our purchases, receivables, payables, inventory. The operating cycle to the nearest whole days is. So how are we going to work that out? We have to work out our inventory days, our receivables days, and our payables days. Our inventory days, receivables days, and our payables days. How are we going to calculate our inventory days? The inventory days is going to have to be our inventory over our cost of sales times 365. So for the inventory days, it would be the inventory over the cost of sales times 365. For the receivables days will be receivables over sales times 365. And for payables days is payables over cost over purchases times 365. So that's what we would do. And the formulas, we have practiced them. And as we said, hopefully everybody had actually started. But to get the numbers, it would have to be for inventory days 185 over 420 times 365. That would give you 161. Receivables days would be the 62,500 over the 500,000 times 365, giving you 46. And the payables days would be the 42,000 over the 280,000 times 365, giving you 55 days. So it would be 161 plus 46 minus 55, giving you 152 days. So for question 4, the answer would be C for that question. And then in question 5, it says using the data from question 4, the sales to net working capital ratio is. The sales to net working capital ratio is. Now for that one, basically you're expected to put sales over the net working capital in dollars. Meaning, so the sales that you have would be 500,000. That is given. Net working capital would be all your current assets minus your current liability. What are the current assets? Inventory and receivables. So inventory, 185,000 plus receivables, 62,500 minus the current liability, which is the payables, minus 42,000. That will be your net working capital. So the numbers that you would have, if I can just probably drop in something here, because something here, add a text. Okay. Okay, so for this one, I can't add text, unfortunately, on this one. However, yes, so it would be 185 plus 62,500 minus 42. All the current assets minus the current liability. So 185,000 plus 62,500 minus 42,000, that would be the net working capital. So the formula is sales over net working capital. So 500,000 over whatever that gives us, the 185 plus the 62,500 minus 42,000. And then that would end up giving us 2.43 as the sales to net working capital ratio. So the answer for that would be A. So for question 5, the answer would be A. So I'm going to flow through progress test 1, but I assume at least the first one would have been done. So we're going to be going through that one quickly. And then I'll probably give you a few minutes while you're doing the other progress test, just to ensure we can cover what we intended to cover for today's session. So question 6. Using the data from question 4 and 5, the increase in cash required to support a sales increase of 30% to the nearest 1,000 is. So they say using that data, right? So now they said that, so what they said, using the data from question 4 and 5, the increase in cash required to support a sales increase of 30,000 to the nearest 1,000 is what? So we said 2.43. Now you have to get number 5 right to be able to even do number 6, right? So, and this is why it's important to know the formulas, because both questions, if you get the first one wrong, you're guaranteed to get the second one wrong as well, right? So it means that you need to know the formula. So now we get number, everybody got number 5 right, but A is the answer, 2.43. It then asks, what if the sales increase by 30%? How much your working capital need to increase by? What is sales? Sales was 500,000. What is 30% of sales? 150, right? 30% of 500,000 is 150. So for the sales to increase by what? If the sales increase by 150,000, you need additional cash of what? 150 over the 2.43, because the ratio is 2.43, meaning that whatever the working capital, well, you multiply the working capital by 2.43 and you can know how much the sales is, because the formula is connected. They're interrelated, right? They're interdependent. So it would be 150,000 divided by 2.43, and that will let you know how much more money they need in order to sustain that increase in activity, that increase in sales. So 150,000 divided by 2.43 give you approximately 62,000, right? So the answer would be C for question 6. So for question 6, the answer would be C. That would be the answer for question 6. Now, question 7 is dependent on itself, but not much information given for question 7. So question 7 asks you, what is the earnings per share? Now, earnings per share is your earnings, right? That is your profit after tax, but before preference dividend, that's your profit after tax, right? Well, profit after tax and preference dividend, but in this case, you don't have no preference dividend, so you don't have to worry about it. So it's really a profit after tax over your number of shares. So that is what is important. How do you get earnings per share? Profit after tax over your number of shares. So in this question, the profit after tax is 300,000. That's your profit after tax, 300,000. All right, what's the number of shares? The question says it at the top here. Share capital, 500,000 5-cent shares. So it's 500,000 shares. So it would be $300,000 over 500,000. And that will give you the earnings per share of 60 cents. So the answer would be C. So your earnings per share would be 60 cents. So that would be the answer for question 7. Then now question 8. If y'all didn't do it, y'all can do it right now. 2 marks. So it's EOQ. Based on the information, the EOQ is the square root of 2 COD over CH. CO being the cost per order, D being the annual demand, and again I repeat, the annual demand, not the daily demand, the weekly, monthly, quarterly. No, the D is the annual demand. So whatever information they give you ensures the demand for the entire year that you have there, right? And then divided by the holding cost per unit, right? So let's hear what you all have for this one. So for question 8, what we have as the answer for question 8. So if you didn't do it, you can do it. It doesn't take a minute. The square root of 2 COD over CH. And you have the CO, you have the cost per order, the annual demand, the holding cost per unit. That's it. Find the square root of that. So tell me what we get as our answer. Is it A, B, C, or D? All right, so somebody got B, right? Only one little thing, but remember it's not dollars, right? The right is units. But anyway, you would get the right answer because you selected the correct answer. So it's units, so the economic order quantity in the nearest unit. So 490 is actually correct because it would be the square root of 2 times 100, that being the cost per order, times 6,000. The annual demand is 6,000, and then you divide it by the holding cost per unit, being 10% of the purchase price of $50. So 10% of $50 is $5. Square root of that whole thing, 490. So that would be the answer. B as in boy, that would be the answer for question 8. Question 9 now. Have a little bit of math for us to work out. A little bit of calculation there. So question 9 says a company with annual sales of $960,000 and average receivables of 2 months is considering offering a 2% prompt payment discount. They estimate that half of their customers will take up the discount and that this will have the effect of reducing average receivables to 1 month. Now, this company currently has a bank overdraft cost of 15% per annum. So we have to look at the costs and the benefit, right? So they are expecting that what receivables will reduce by 1 month, right? Now, they told you that their annual sales is 960,000. So they are anticipating that their receivable is going to reduce by 1 month of that. 1 month of 960 is 1 over 12 times 960 would mean that the receivable is going to reduce by $80,000. That's what they anticipate, right? So they anticipate that their receivables is going to reduce by $80,000. Now, that being the case, it would mean then that it would reduce their interest, their overdraft costs, 15% of 80,000. So one of the first benefit they're going to get from this is that they're going to be paying less interest, right? So 1 month worth of sales, they're going to be paying less interest on that. 1 month is 1 over 12 times 960,000. Since a whole year is 960, 1 month out of that would be $80,000. So they'll be collecting 80,000 earlier. What is the interest cost? 15% of 80,000. 15% being the overdraft cost. So they would be saving $12,000. That's the benefit. They have to save 12,000. But in order to save the 12,000, they're going to be giving up a discount. They're going to be reducing the amount they would have to collect. What did they say? 2% discount and half of the customers going to take up that. I mean, out of the $960,000, half of those people going to get a 2% discount. So that's going to be a cost to them. So half of 960 is 480, and then 2% of the 480 is what we're going to do. So we say what? 2 times 4896, so 9,600, right? So it means then that the benefit of interest savings is 12,000, but the cost of the discount cost is 9,600. Again, how we get the 96? Half of 960,000 is going to take up the offer. That's 480,000. What is the discount? 2%. 2% of 480,000 is 9,600. So they're saving 12,000 in interest, but it costs them 9,600 in discount costs. So what is the difference? 12,000 benefit minus 9,600 costs give you a net benefit of $2,400. So we'd end up with a net benefit of $2,400. So that would be their net benefit. So question 10, the last multiple choice on this first progress test. It says bonds that are issued by the company at a large discount to their eventual redemption value, but on which no interest is paid until redemption, what are they called? So what do we know? Now, this is a theory question. What type of bond is this? Is the definition of a bond. Which one of the bond? Is it loan note, zero coupon bond, equity bond, or floating rate bonds? What is the answer to question 10? What we get as the answer to question 10, is it loan notes, zero coupon bond, equity bond, or floating rate bonds? It's zero coupon bonds. So that is correct because zero coupon bonds they're actually rare, by the way. They're actually rare. Floating rate bonds are bonds on which the interest rate they're altered periodically because they're trying to bring it in line with the market rate of interest. So that's what it's called. That's why it's called floating rate because it adjusts with the market, right? In order to reflect the market value or the market rates. We are familiar with loan notes and equity is equity. All right. So for the theory questions, we are going to leave that. I'll just send you all the solutions. You all must ensure though that you all study the theory. But in the interest of time, we won't be able to do all theory questions. We'll discuss some But most in terms of time, we're going to ensure that you all do them. So do not ignore the questions. If you don't know the theory, you're guaranteed to fail the exam, right? It's impossible to pass if you don't know the theory. No matter how good you are with the calculations, it's impossible to pass if you don't know the theory. So do not ignore the theory. Ensure that you read them, try them, attempt them, keep on going through to ensure for reinforcement purposes. So now we're moving on to progress test 2. So I'm assuming that maybe everybody didn't reach progress test 2. So what I'm going to do, I'm going to give you all about 10 minutes or 5 minutes. I can't give you all so much time. So 5 minutes to work 2 or 3 of the questions, and then we are going to go through these questions. So now you're seeing the first 3 questions. Use 5 minutes, work through those at least very quickly. If you have done them, then you can continue the other questions you probably didn't get to reach. So I'm giving you 5 minutes, questions 1, 2, 3, and then let's go through and continue onwards. All right, so let's see. So question one, what is the payback period? So payback, as we know, is a running balance. You spend $120,000 and you're receiving, based on, they say the expected life annual cash inflows is 40,000 per year. So that's a quick one. 40,000 per year would mean after 3 years, you get back the 120,000 straight payback. So the answer is C for question one. All right, so question two, it says using the data in question one above, what is the return on capital employed using the average investment base? Average investment, as you know, is initial investment plus scrap value divided by 2. That's the denominator. And then now we're going to be looking at the average profit. So what did they say? They told us that the expected inflow is 40,000 a year, but the annual depreciation is 20,000. So it means that the annual profit is 40 minus 20, 20,000 per annum. So if the average profit is 20,000 per annum, and the average investment will be 120 plus 20 divided by 2, 70. How we get the average investment again? Initial investment, 120, plus scrap value, 20, divided by 2. 120 plus 20, 140, divided by 2, 70. So that would mean
Sir,
the answer would be,
excuse
yes.
me, sir, you're moving a little bit too fast.
Oh,
You're
you
lost.
didn't try it? Tell me where were you at? Were you wait? You tried the question already? What you got as your average investment?
I didn't try that one.
Oh, all right. So when I'm giving you all the time, I'm asking you at least look on the
I didn't
information and
reach
give us
that
the
one,
comment.
sir.
Okay. All right. So for the average profit is going to be the expected annual cash flow minus the annual depreciation, right? So the formula itself, let's look at the formula first. So ROCE using average investment is average profit over average investment. So that's the formula first. If we don't have that, we can document that now, right? So ROCE, the average investment method as they ask us for, would be the average annual profit over the average investment. All right, so the average profit, so let's do the numerator. The average profit is going to be the inflow minus the depreciation, right? So the average profit is going to be the inflow minus depreciation. So the numerator first. So the numerator is going to be 40,000. That's the expected annual cash inflow minus the annual depreciation of 20. So 40 minus 20 would be the numerator, right? So the numerator, 40 minus 20, 20,000. The denominator now is going to be the initial investment plus the scrap value divided by 2. The denominator, the initial investment, 120, plus the scrap value of 20 given right here. So that given now 140 divided by 2, 70,000. So the denominator in the formula is going to be 140 divided by 2, which is 70,000. So again, numerator, average profit, 20. Denominator, average investment, 70. So the ROCE would be 20 over 70, giving you 28.6%. Right? So that would give you 28.6%. So since, all right, so I'm going to give you all at least 2 more minutes to the number 3 now, since y'all didn't reach that one as yet, because I really want y'all to work it. So I want to review the question with you, right? So that you make an attempt and then we'll go through it. Right? So for question 3, I'm giving you all an additional 2 minutes. Attempt question 3 now, and let's go through question 3. So we'll give you a few minutes to attempt a few, and then we'll go through them. So that I think that will be more beneficial. At least we are seeing where the numbers coming from. So I give you all 2 minutes. Question 3, attempt it, and then let's discuss the solution to question 3. All right, so let's look at let's look at question 3. So here we have the workings for question 3. All right, so question 3 says using the data in question 1, calculate the NPV. We know it's 40,000 per annum, so they use the annuity. You may not have done the table the same way, but you'd have got the same result. Times year, you spend 120. Times 1 to 5, you receive 40,000. And in year 5 as well, you sell it for 20,000. So you get an additional 20,000. So your annuity at 10% discount rate for year 5, 3.791. The 20,000 can be joined put in the annuity. That what you sold it for the end of the 5 years, because only year 5 they get that money. So use a discount factor year 5 at 10% being 0.621. Do your discounting, get your present values, the sum of the present values being the NPV, and that would give you $44,000. So the answer being B as boy. So B being the answer. So that would pretty much be the solution for question 3. That here is your 2 marks. So again, so if we notice, knowing the formulas, doing the calculations quickly in the exam, you have to manage our time because we realize that time is of the essence. So let's look at question 4. Let's shift the class here. Now again, no, this is not yours to do. A project has a life of 3 years. In the first year, it is expected to generate sales of 200,000, increasing at the rate of 10% per annum over the remaining 2 years. At the start of the year, working capital is required equal to 10% of the sales revenue for that year. All working capital will be released at the end of the project. What is the present value of the working capital cash flows? What is the present value of the working capital cash flows of the project, discounting at a rate of 20% per annum? So what are they doing there? So it really is not a difficult question if you understand it. I want you to read it again. We're going to go through it now. But I want you all to read it on your own. Let's go through it right away. It's not a difficult question. So we're going to go through it together. So just read it now. We go through it now. All right, so it says to the nearest $1,000. So rounding it to the nearest thousand. So they're rounding them. So based on the information we have here, the working capital you're going to start with is 10% of 200,000. Now, if you need to maintain this purchasing power, they say it have to be equal to 10%. So they're giving you a lot of things. They said it's increased at 10% and it has to be 10% of 200,000. So what that means is you're going to start out 10% of 200,000 20. And every year you increase by 10%, right? So, and then they want you to calculate what is the present value of these cash flows. You know that generally when it comes to working capital, you recover what you need in the final year, right? So yes, in the first year. So you're going to need it. Time 0 is when you need the working capital to start out with, then time 1, and then time 2. So let's see if this is how y'all interpreted it. And this is why I said we'll just move on to it very quickly because it's not one of those difficult questions. Right now you need $20,000. It have to increase by 10% per annum. So reach 22, 10% of that, 24.2. But you already have 20 in the bag already. So right now you have 20,000 out there. You're going to have an additional 2 and then an additional 2,200 because you're just increasing the balance. It's like you have a float and you have to increase the float by 10% each year. That really is what it is. You have a float and every year you have to increase it by 10%. But when you're finished with the project, you give back the people them money. So pretty much you just feel so the float is replenished in the last year where you recover everything. The discount factor they say must use is 20%. Look on the present value table at 20% for year 1, year 2, and year 3. Do your discounting. Get your 9,000 mash. It don't reach 9,500. So when you round it to the nearest thousand, it's going to be negative 9,000. So the answer to question 4 is going to be B for boy. So that would be the answer to question 4. All right. So now moving on to question 5. Again, give you 2 minutes. Read it, make an attempt, and then let's go to question 5 as well. All right, so question 5 now. What is the NPV of the project? Again, once we pick up the information that we have, it says they want to embark on a project. It involves initial outlay. Right now, they have to spend 100,000, right? And then they said that the cash inflows at current price is 50, 60, and 40, right? Inflation expected to be running at 10% per annum, and the real cost of capital is 10%. You know what is lovely about this is that they give you current prices, right? Current prices mean it does not include inflation. Real cost of capital also means that it does not include inflation. So if you want to work out this thing quickly, you don't need to worry about that inflation they give you. That is just to throw you off. Because the cash flows does not include inflation, and the discount rate does not include inflation. Just run with them as is. So right now you have in time 0 you have a negative 100, time 1 you have 50 positive, time 2 you have 60 positive, time 3 you have 30 positive. Discount them by the 10% per annum, and then you're good to go, right? You discount them by the 10% per annum and you're good to go. So pretty much it's going to be $25,050, right? Of course, to the nearest thousand. So that would be $25,000. So your answer to question 5 would be C. So that's it. So you just look at it. So don't make them confused with inflation. Inflation important if they know, if they gave you, for example, the money cost of capital, which includes inflation, but the real cost of capital exclude inflation. When they say current prices would mean that it exclude inflation. So if both of them exclude, just run with them as is no adjustment necessary. So that would be the answer for question 5. Moving on to question 6 now. Give you some information there again. Give you another 2 to 3 minutes. Read it, do it. So we're going question by question. So y'all can actually attempt the question. So even if you didn't get a chance, some of you may have. If you did, you can move on to the others. But if you haven't, let's use this opportunity. Let's work the question and then let's go through them. All right, so let's look at question 6. So based on the information, it says if the company's cost of capital is 10% per annum, what is the present value? And we have to pay attention. You notice that these are 2-mark questions, right? Meaning that you should be able to complete them within 3 minutes. When I give you 4 minutes, that's actually more than the time you're expected to complete them in. So we have to be able to complete them. You have to be practicing. Weren't practicing before, can practice now. And it's good because a lot of us, even if we're working from, a lot of us really not working from home. So we can utilize the time and try and catch up on some of the things that we haven't been studying. So for looking at question 6, let's see what they said. So what we're going to do, we know we have some capital allowance to work out, right? But this one is not difficult. It says if the company cost of capital is 10%, what is the present value at the 1st of April 2026 of the tax allowable depreciation? So that's all they want you to focus on. So basically, you pay 2 million for the asset, cool, and then they say 25% tax allowable depreciation. That's what them say. So in the first year, 25% of 2 million. That's it, 500,000. Good to go. And then they say that on the reducing balance and a balancing allowance available on the disposal. Now, they purchased this asset on the 1st of April, right? The company expects to sell it the 31st of March 20x8. So that means the second year them sell it, you know. So 1 year tax allowable depreciation. So 1 year capital allowance. The other year now basically dispose of it. So let's look at what we can in terms of the workings y'all should have for the present value. Just get a second here. So again, so as you notice, it might hold a whole heap of information, but then when you see it's 2 marks, you know, they really couldn't expect it to be doing a whole heap of workings, right? So 2 marks worth, that's what they want you to focus on. This is all I want you to focus on. Pay 2 million for it, 25% of that 500,000. Okay, you know, if you're gonna look on the tax effect, okay, that's wonderful. Tax effect itself is that the tax rate is 35%. So 35% of 500,000 is 175. When you're going to see that, time 2. How we know that? Remember, when you purchase an asset on the first day of the accounted year, in this case, it was the first day. When tax is paid in arrears, and if we don't remember this rule, all of us would have written down this rule, but if we don't remember this rule, then we can put it down. Whenever tax is paid in arrears and you purchase an asset on the first day, the first tax savings will occur in time 2, right? So whenever tax is paid in arrears and you purchase an asset on the first day of the accounting period, the first tax savings you're going to see is in time 2. If you had purchased it on the last day of the accounting period, then the first tax savings you would have seen would be in time 1, right? But in this case, you purchase it on the 1st of April. So the first tax savings you're going to see is in time 2. The second year is when they said that you dispose of the asset, right? The second year they said that you dispose of the asset. Because they told you that the company expect to sell the machine on the 31st of March for $500,000. Now, the way to do this is kind of strange, but I mean, we wouldn't do it in that way. It means that the asset worth $1.5 million, right? And you sell it for 500,000. That's how we would do it. So if it's worth 1.5 and you sell for 500,000, you lose $1 million, right? So that's how the direction they do it in the answer. And this is why when you all studying the answer, sometimes it confuses you even more. The layout here is not how you understand it. If the asset worth 1.5 million, you sell it for 500,000, right? So that figure there should be up on the line. So you sell it for 500,000. That means you lose $1 million, right? If you lose $1 million, the government not going to tax you, you're going to save on taxes. And what is the tax rate? 35%. Whatever you lose, you're going to save the tax on that. So it's going to be 35% of the $1 million to give you the 350, right? So the order in which they do it, I mean, the final answer is still the same, but this might confuse you. You might be looking and say, sir, where the 1 million come from? It's not there. The 1 million is where you actually have to work out. What is there? The 1.5, the 500,000 from the 1.5, you give you 1 million. So you would actually have that as your bottom line. And then now you do 35% of the 1 million to get the 350, right? So then we discount it. So I don't want you all to focus on let me just wait until we get the answer, because the answer sometimes might confuse you, right? So it's important that we still try to understand the principle. So how we're going to do this now? Year 2, how them do this present value working? The 175,000 would be in time 2. That means you have to look for the discount factor at 10% for time 2, right? And the 350,000 would be in time 3. So you have to look at the discount factor 10% for time 3. Then when you discount those cash flows and add them up, you get the present value of 407,400. That is a little bit strange, because you'd have to just work with the closest answer that is there. Because it says to the nearest thousand, but to the nearest thousand, this would be 407. But the answer that is given in the text here is 408. I guess they round it early. Not sure why they would do that, but clearly if you have 4074 and you don't say a 407, you have to use the closest answer. So the answer would be B for question 6. Right, so let's continue in the same trajectory. So question 7. Again, this one is now 4 marks. So you know this one needs some workings, right? For 4 whole marks, it means that them expect you to do some workings. The 2 markers, they don't expect a whole lot of workings. But clearly, if they tell you 4 marks, then you know so you expect to do some workings. So for this one, I'm going to give you 5 minutes and then we'll go through it. Maybe you don't, if you haven't attempted it yet, you probably won't finish it, but you'll be close to finish within 5 minutes. I'm giving you 5 minutes to do question 7, and then we will go to question 7. All right, so let's see. What do you have for question 7? All right, what say you? So now based on information, yes, it requires some working. So you have to work on the cost of capital because the information you receive, it says sales are in real terms, right? Then they tell you inflation is estimated to be 4%. And they say they have a real cost of capital of 7.7%. They tell you what the project investment is. So they give you a good bit of information. So working out the cost of capital to do your discounting would be 12%. But again, we know that there are two ways to do your working. But if we remember, then that's good. If not, then of course we'd have to just stick to whatever we remember or revise. You know, we did money cost of capital, real cost of capital, you know, how you do your discounting when you have the real cost of capital, how you do with the money cost of capital. We don't remember, then we can do our little recap. But in this instance, I tell you that inflation is estimated to be 4% per year. And Boys, Toys and Company, they have a real cost of capital of 7.7. Now, why it is important that we have to use the real cost of capital is that we get inflation, and they also tell us that post-tax profit margin are estimated to be 45% of sales and working capital 15% of the coming year sales. Now, we know the sales is going to increase by the inflationary amount by 4%. So we know that we're really going to have to do some maths there, right? So we're going to have to do that working. So and this is how we got the numbers here. So for example, we start out with 45% of 2 million of what is it? The project, it says sales is 2.5. So 45%, no, 15% of the coming year sales, right? So 15% of the 2 million is 300,000. But that is real terms. I mean, that is what it is now. 1 year from now, it will be affected by inflation. So it means it will increase by 4%. So 15% of 2 million is 300,000. 1 year in year 1 year from now would mean that it have to increase by 4%. So the 300,000 increase by 4% would give you 312,000. And this is why we have to have those numbers right. So it would be 312,000. And then of course, you keep increasing it by 4% per annum. But again, we have to remember, we start out with 300,000 working capital. Each year, you're just going to increase the float. You're going to increase the float by what else you need. So at the end of year 1, you need 12 more to bring it to 312. At the end of year 2, you need another, call it 12 to 13 more to bring it to 324. Another 13 more to bring it to 337, like that. And then in the final year, recover all of the money. The initial 300 plus everything else that you needed to spend. So that is what you'd have to make sure you account for, right? So the numbers there, you know, if you notice, how did they get the net income as well? You might be wondering, how them get this net income? Because you are told that profit margins are 45% of sales, all right? So let's do the math. 45% of sales. 45% of 2 million is 900,000. But again, that's the sales right now. 1 year from now, the sales will be 4% higher. So we have to increase this 900,000 by 4%, giving us 936. And then every year, it increased by 4%. 936 increased by 4%, 973 increased by 4%, 1,012,000, etc. So the net income figures, think we can follow that. The working capital figures, we can follow that. Getting our net cash flow. And then the discount factor would have to have worked out because the discount factor they gave us was the real cost of capital, meaning the cost of capital without taking into consideration inflation. When we account for inflation, the cost of capital is actually 12%. So that's what we have to use as our discount factor. Discount all our cash flows and then get our net cash flow to be 977,000. The answer being B for question 7. So that would give us the answer as B for question 7. Questions 8 and 9 are based on this scenario. So 8, 9, and 10, I think you probably would have started it. So I'll just give you 5 minutes and then we can wrap up these questions and move to progress test 3. right? So questions 8, 9, and 10. Just let you all give you 5 minutes to work that. 8, 9, and 10. All right, so, and then we will just go through all three. So after the 5 minutes, let's go through all three, and then we can move on to progress test 3. All right, so let's go through questions 8 to 10, and then we can move on to progress test 3. All right, so question 8 asks you what will be the best NPV attainable, assuming that the projects are divisible. What they're asking you, calculate the profitability index and tell me what the answer is. So that's what they're asking you for. Because they say, assuming the projects are divisible, the best NPV attainable. That would be profitability index. So calculate the profitability index, the NPV per dollar invested, and then rank them based on that. Whichever one is giving you the highest amount per dollar invested, right? And then, of course, you're doing your combination. So rank them first and then start sharing out the fund based on how you're going to spend and what proportion is left. So you know you could invest based on the amount of money that is available. You could invest in all of K, L, and M because 90,000 is needed for K, 60 for L, and 150 for M. That's 300,000. Right? So that gives, sorry, that's giving you 300,000 because after your fund K, L, and M is $90,000 you spend, right? Out of the 100,000 you have available. Now, for N requires an investment of 60,000. We only have $10,000 left. So 10 over 60 is what you're going to invest. So you can invest in 16% of it and get 16% of the money. So you get 300 of the first 3 that you invest in, and then 16.67% of the 120 from N, giving you 320,000. All right, so that seems to be the answer there. It should actually be, so C is the answer there, 320,000 for question 8. That is assuming that they are divisible. Question 9 now, again, that one shouldn't take much time. It says, what will be the best NPV attainable, assuming that they are indivisible, meaning you can't divide the projects. So you're going to now look at the best combination. So for question 9, you're going to be looking at what is the best combination. So when you combine K, L, and M, you get 300,000. That is $90,000 you spend, and that's it. You can't spend no more money. You can invest in K and N as well, and then you have no more money. Because K is 30, N is 60, that's 90, and you can't invest in anything else. But that will give you 210. So the best combination will be K, L, and M, giving you an NPV of 300,000. So the answer to question 9 being B, as in boy. So that would be the solution to that one. And then last but not least would be question 10. They ask you, what is the net cost or benefit of leasing? So what you're going to do, of course, you're going to now do the math, right? So in terms of, you're going to be doing your comparison. Now, y'all may not have done it this way. You probably would have worked out the NPV of purchase or the NPV of, and the NPV of leasing. Remember, when it comes to leasing, what are the relevant cash flows for leasing? The relevant cash flows for leasing will be the lease cost and the tax savings on the lease cost. That usually would be the relevant cash flow for leasing. And for purchase, the relevant cash flow for purchase would be basically the purchase costs, right? The tax savings and capital allowances and the scrap value, right? So yes, you might not work it out this way. So I'm not even going to spend much time on it like that because this is not the method that you would have worked it out, because you would have known that when you're doing purchasing outright, you're going to use it, do the NPV, and the relevant cash flows will be the cost of the equipment, the tax savings on the capital allowances, and the scrap value. Those would be the relevant cash flows. And then you would work out the NPV of leasing. The relevant cash flows will be the lease cost, the lease cost, and the tax savings on the lease costs. And then you do your discounting, and then you compare the two. Which one is cheaper, right? Which one is more beneficial? In this case, when you do the math, you realize that there's actually a net cost of leasing, meaning that it is cheaper to purchase in a sense. So leasing costs you $705 more than actually purchasing outright. So the answer would be A for question 10. All right, so we're going to try to do progress test 3 at least, and then we can do one of the online quizzes quickly. So we're going to look at progress test 3. Even if we don't get to do progress test 4, I know we said we do course exam 1, but I'm sure since we didn't get a chance to do most of the questions. We won't be able to look at that one today, but I will still share the solutions for progress test 1 to 4. So even though we'll be doing just the first 3, you'll get the solutions for the 4th. You can do that one on your own. And again, just apply the principles, because some of the solutions might confuse you more than assist you. So focus on the principles, do your calculations, and then you should get the right answer. All right, so progress test 3 is what you're going to be doing now. So again, this one now, I'm going to give you 5 minutes to do the first 3 questions, because not much in the first 3 questions. So 5 minutes, do the first 3 questions, and let's just go through these 10 quickly, so we can do at least one of the online quizzes that I have tailored for you all. So let's do that. We do one of the online quizzes, and I'll share the solutions to all 4 progress tests, so you can still attempt all 4 of them that is in the handout. So 5 minutes, questions 1 to 3. All right, so let's look at these three so far. Question one says, what is the theoretical X rights price? In other words, what is the new market value? So they said it's a 4-for-1 rights issue. Mean 4 shares are currently worth $7.50. And you can get, if you own 4, you can get 1 for $6. So what's the value? What would be the average value of all 5 shares now? If you have 4 shares at $7.50 and you purchase 1 at $6, it means you have 5 shares that now worth $36 to you, because the 4 at 750 is worth $30, but one of them you paid $6 for it. So $36 is what the 5 shares is worth. Divide that by 5, you get $7.20. So the theoretical X rights price is $7.20, B being the solution. Then the question says, using the data in question 1, calculate the value of the right to buy 100 shares. Calculate the value of the right to buy 100 shares. Now, if the new market value is $7.20 and it's $6 for you're paying for a share, you have the right, the value of a right is $1.20, because you just work out that the new market value, which is a theoretical X rights price, is $7.20. Again, you see, if you get that wrong now, your number 2 definitely is going to be wrong as well. So this is why it's important to just know the formulas. So $7.20 is the new market value. Them tell you $6 you pay for a share, but you're right, you have the right to pay $6 for it. That means the value of a right is $1.20, right? $1.20. So 100 rights would be $1.20 times 100, which is $120. Answer being D, as in dolphin. So that would be the answer for question 2. And last but not least, if you say would do within the time. Question 3 says the company's ex-div market value, now we always want X, so that sounds good, is 184 cents, which is $1.84. Okay. Assume a dividend of 16 cents has just been paid. Okay, just been paid. Wonderful. It's not about to be paid, but it has been paid. All right, 16 cents is the dividend. The growth rate is 10%. Wait, they're giving us everything we need. What is the cost of equity? We have everything we need for the formula. We have the growth rate, 10%. We have the dividend, 16 cents. We have the market value, $1.84. So let's do the math. The cost of equity is DO1 plus G over MV plus G. So the dividend, 16 cents times 1.1 over $1.84 plus the growth rate of 0.1, giving you 19.56%. But to the nearest percent is 19.6% they give us. So the answer is D, as in dolphin. So that covers the first 3 questions in the progress test so far. So yes, it's 10 of them. And as I said, we're going to take our time, go through these 10 at least, and then try to do the online quiz. So we'll just do that. Questions 4 and 5. Let me give you probably another 4 minutes for that, not too long. So 4 minutes for these 2 questions. Let's do these 2 quickly. Because they give you some historic dividend here. So it sounds like them want you to do cost of equity again, growth rate. You have to go work out lovely stuff using historic dividends. All right, so we have some information here that we can utilize. So 4 minutes to the questions 4 and 5. All right, so let's look at questions 4 and 5. Question 4, you have to work out the growth rate over the last 4 years. So yes, 1, 2, 3, 4. So 4 years of growth, you find the fourth root of the original over the, so you have the most recent over the first dividend. Now, the most recent dividend that we have in this case. So we have, so you have 30 times 1 plus G, then give you that. All right. So again, as I said to you, you really can't use the method that they use in terms of the math. The dividend that you just declared was 41 cents, and you started out at 30 cents 4 years ago. So it's going to be the fourth root of 41 over 30, whatever the fourth root is minus 1. And then that will give you what your growth rate is, being 8%. Plug that into your formula now. Your dividend being 41 cents, growth rate being the 8%. Your market value of your shares, 810 cents or $8.10. That gives you a cost of equity of 13.6%. Right, which will give your answer to be A. Question 5, they ask you, what is the current cost of capital of the company of these bonds? So again, question 5, this one is nothing too much to worry about. Them give it a tax rate, so you know, say that it's irredeemable. Irredeemable bonds is just the interest over the market value, but then the interest going to be net of tax, right? 1 minus taxation, since we're working out the cost to the company. The cost to the company, you'd have to know that the company is going to get tax relief. So you have to take into consideration the interest net of tax. The interest is going to be 12% on the 100. We have to remember that. What is important? 12% on, because I tell you, Sultan issued its 12% irredeemable bonds at 102. That's what they issued it at, right? Okay. But the current, and normally we know that these bonds, the par value of bonds are $100. So 12%, the interest will be 12% of 100 being $12, but it has to be net of tax. So times 1 minus T, so it would be 0.6 times 12, right? Over the market value. And they said the current market price is $95. So it's over the market value of 95, giving you 7.6%. The answer being C for question 5. So C would be the answer for question 5. Now you're going to work through question 6 and 7. Now for this one, of course, question 7, yes, is a little bit big. So let's give you about 6 minutes to do 6 and 7, and then we go through those, and then we just have 3 more questions left. So question 6 and 7, 6 minutes, work through those 2, and then we will do the final 3 and complete that so we can move on to the quiz thereafter. All right, so let's see what we have for question 6 and 7. Question 6 says, the estimated cost of light cheese company equity using the dividend growth model and market price is, again, DO1 plus G over MV XDiv plus G. All the information is there already, all the information is there. 35 cents is the dividend. 10% is the growth rate. $2.50 is actually the current market price. That's it. That's what you need. 25.4%. So yes, a lot of information, but that really is a 30-second calculation. Then now 7C now. 7C, 7, the answer is C. How we get that? There's a cost of equity using CAPM. A lot of the information is already there as well. We have the market rate, we have the risk-free rate, we have the tax rate is not needed for CAPM. But we have that. And then now let's look at in terms of our beta. We actually even get the beta as well, because they told us that the beta factor is 0.9. So for the cost of equity, very quick. The cost of the preference share, very quick as well, because 7% $1 preference share, the market value is 50 cents. There's going to be the preference dividend over the market value. 7 cents, guys, on a dollar. 7% of a dollar is 7 cents over 50 cents. So that's the market price for the preference share. 14%. Good to go. The loan stock is irredeemable. So irredeemable would be interest over the market value, and you're good to go. The interest, the loan stock is 12% loan stock irredeemable. The market value is $80. So $12 over $80, 9.75%. So again, even though it's 4 marks, it's really, they didn't really expect to do not much, right? So all the information is there. Very quickly, you work out the cost of equity, the cost of the preference share, and the cost of the loan stock. Then now you just compare your market values, however, whichever method you want to use, whether you want to put all the market values and then treat them as a percentage, or put the market values times the percentage and add them up. For example, the equity would be 17.4% times 80 over 106, because the market value of the equity is 80 million, means 40 million shares at $2 per share, right? So the market value is 80 million. The total market value of the equity, preference share, and loan stock is 106 million. So you could simply do 17.4% times 80 over 106 plus 14% times 10 over 106 for the preference share. For the loan stock, 9 plus 9.75% times 16 over 106. And then you would get your weighted average cost of capital of 15.9%, which is C for question 7. So again, it's not really a lot of working, but once you're studying, once you're practicing, you realize that information comes easily. So that's 4 solid marks, and it really wouldn't take you a lot of time to work out to do that question. So what I will do now is give you 5 minutes for the last 3 questions, 8, 9, and 10. Again, as I said, you'll get the theory. Do not ignore the theory questions, and show you practice theory questions as well. We're only doing this in the interest of time. So I'm giving you, let's make it 6 minutes for questions 8, 9, and 10. And then thereafter, we're going to just quickly do one of the online quizzes before we wrap up. And I'll share the solutions to progress test 1 to 4, all 4 of them. So you'll have to do progress test 4 on your own and review the solutions as well. So 6 minutes, questions 8, 9, and 10. All right, so let's look at the numbers that you may have. Let's go through them quickly because no time is against us. Would like to do the other, at least one of the other quizzes. All right, so let's look on the numbers and see if that's what you got for question 8, 9, and 10. So I want you to look on that and see if those are the numbers that you have. What was this again? 1 second. Wayground. I think that was it. All right. All right. Hold on a second. So we had that. All right. So let me see now. Previously used. All right, so those are the, so for question 8, the answer being B, working out the number, looking at what you have to get your cost of equity. You would have had to calculate the growth rate. You'd have had to done your growth rate calculations, and it clearly is 4 years of growth, right? Between 2021 and 2025, that would be 4 years of growth. Look on the most recent dividend being the 379 over the first dividend issued of 300,000. And then, of course, you know, you minus your 1 to get your 6%. That plugged in gave you a cost of equity of 23%. Question 9 now. Question 9 now, of course, you have to work out your beta. So based on the information, again, you need your asset beta. So what you'd be doing is calculate. You have the equity beta of 1.2, your equity being 4, your debt being 1, the tax rate being 28%. That giving you your asset beta. It has to be lower because we know the asset beta only carries one risk component, which is business risk. The equity beta carries two components. As we said, the asset beta is pregnant with one child, the equity beta is pregnant with twin. So it means then that the asset beta will always be a smaller number. So if you see you get a bigger number, you know you did something wrong. So the asset beta will always be a smaller number. Get that, plug that in your CAPM formula, and you get 8.1%. Now, continuing from the information you had there, this was where the company was all equity finance, meaning they only had equity alone. But what if now they plan to finance it with an equity to debt, a debt to equity ratio of 1 to 2? Then you're gonna have to re-gear that asset beta. You have to calculate a new equity beta. And that's what question 10 is all about. Calculating the re-gearing the new capital structure into it, you're going to get an equity beta of 1.383. And then, of course, plug that in your CAPM formula and you get 9.53%. But that is just the cost of equity. The fact that you have debt as well, you're going to need your weighted average cost of capital. So you have your cost of equity, 2/3 is equity. Your cost of debt, you can use your risk-free rate, net of tax, so 4% net of tax, 1/3 is debt, and then that will now give you a weighted average cost of capital of 7.3%. Right? And that basically would cover those 10. As I said to you, the theoretical questions. So for the other questions, I'm going to send you the solution to section B. But as I said, please attempt it, practice the theory, study the theory. It is necessary in order to pass the exam. I will send you this paper, which has the solutions at the back. So yes, you're going to see the questions as well. So some may say, sorry, still send about the questions. No, yes, the questions are there, and behind each progress test, the solutions are there. So if you look on the screen, you see it's a progress test 4. Here are the questions, the progress test 4. right after you have the solutions to progress test 4. So for all of them, it's like that, right? So you'll see the paper. So I know some might say, oh, sorry, you saying about the question. Just go through it. So progress test 1, these are the questions. And if you notice solution, progress test 1 solution is at the back of progress test 1, right? Then now we're going to progress test 2 questions. The solutions are right there behind it. So you can go through again. You can rework them. Since we didn't do progress test 4, you can work progress test 4 on your own and then go through the solution. What we want to do before we end is just attempt this quiz. So we have 15 minutes maximum to attempt this quiz. Again, go to joinmyquiz.com and type in the join code that you're seeing on the screen. And let's just do that quickly. So we're gonna try and we'll complete it. It's not long. It's multiple choice questions. So we'll try and use the next 15 minutes and complete it. If we're not done, then we will end the session on it. And you can always go and practice these on your own. So can quickly join it now. So we can see if we can do as much as possible within the few minutes. So just go to joinmyquiz.com. So type that in your browser, open another tab, or if on your phone, just open it on your phone, joinmyquiz.com, and then enter the join code, which is 589193. All right, so let's quickly join. Joinmyquiz.com. So if you're on your laptop now, you can just do this on your phone, open a browser. Or if you're still on your laptop, you can just open another browser because it's Zoom you're on now. So just open your internet, whether it be Google, Chrome, Explorer, Safari, Opera, whatever. Open on your browser, join my quiz, type in joinmyquiz.com, and then type in the join code 589193 so that we can start the quiz and just go through these questions quickly. All right, so the other two, please join quickly. Want to start it in 10 seconds, so let's join quickly, please. I'm going to start. You can still join, so please join very quickly. I'm going to start it now because we really can't wait 15 minutes. So I'm going to start it now. You can join still. So joinmyquiz.com and type in the join code. Again, joinmyquiz.com, and the join code is at the middle top, the top center of the screen. So you can still join. Join myquiz.com and enter that. There you go. So I leave it like that because you all don't really need to see the quiz being played. So just look on what's on the screen and go ahead with that quickly, please. All right, so what I'm gonna do, I'll end the session, but I won't end the quiz, right? I won't end the quiz. So I'll end the quiz at 8:35. So I'll just end the session. Y'all can still continue the quiz. And then thereafter, at 8:35, I'll end it. So you'll perform, you'll see, and you'll see what you got at the end. All right, so I'm just gonna end the session now, and at 8:35, I'll end the quiz. So you can keep playing, it won't affect the quiz at all. Let me just stop share and end the session.